Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. We thank you all for taking time out of your busy Wednesday mornings to join us. Happy October 26th. It's almost Halloween. I can't believe we are already approaching the holiday season. Well, as you can see, bottom left-hand corner of your screen, it's been quite the volatile past 12 to 24 hours, with markets continuing through resistance, only to turn lower in the after hours following reports out from Google, aka Alphabet, and Microsoft. We'll talk about that with the team in just a few minutes. Before we do so, let's go ahead and get them in here. If there's any issues today with the video, please let me know if you guys are having any issues with the stream. Ever since the undersea cable cut, there have been packet loss issues here in Texas, so we'll see if we can get through this one. Good morning, team. How are you doing today? Welcome, welcome.
Good morning, guys.
Hey, guys.
Good morning.
What's up, Alex?
It's crazy to think that, crazy to think that cutting a cable in the Mediterranean would have anything to do with internet in Texas.
You know, the way they reroute things, it is quite surprising, but it's quite the event. We'll see how things shake out.
Everything you say goes around the world multiple times before it comes back to you.
That's insane.
So,
all right,
viewers, if you're in chat, if you could let us know if the signal is good, or if there's any issues, we would greatly appreciate that. So, what's new? What are you guys thinking about this move in the market overnight?
Boy, it's yeah, that was not a good look out of Google, with specifically YouTube. Pretty big drop in advertising. We've been through this last quarter, right? I think Snap comes out first. We went through it last quarter. Snap repeated a very downbeat outlook for advertising. The whole social media social media stocks kind of took a dive. And here we go again. Snap came out, and then you get YouTube sort of confirming that advertising is coming off. So looks like they're taking it to heart here. I don't know. We were talking before the show, and I'm interested to see what Terry has coming in. Communications were showing some pretty good relative strength, and Google was. Netflix is well off the lows. Communications has been kind of a beaten down sector. Had some steam going, and then the report last night really didn't help things. So I'd be interested to see how they handle this gap down on the open here today.
Yeah, the sector overall was gaining some strength, but it really wasn't coming from Google. So it was many of the other communications names in that group, and that's what I've been telling people for the last several weeks. We got to get Google on board to get this thing moving, and that's not happening just yet.
Somebody said the stream is so perfect they can hear Terry's clock. I love it.
Good.
Love it. I love it. Yeah,
that clock runs 3 minutes early. I don't want
it really?
Usually timing right on top of the hour. So
staying on top of things. I love it. Yeah, so let's take a look at the markets. I think, given the move up that we've seen at this point, I see really two outlooks moving forward. So eager to see how the remainder of tech earnings are absorbed, and then with next week's Fed decision, I think we should have the catalyst to establish trend into the remainder of Q4. What do you guys think?
Yeah, we shall see. There's a lot of decisions being made here. This is volatility came off a whole bunch yesterday. The VIX, I thought, was making a pretty big move lower. There's a lot of signs from an intermarket point of view. Dollars off. Interest rates are starting to move back down. Bonds trying to find a low. They're trying on all sides, and we're in some pretty key technical support here. A lot of decisions being made. I don't know though. I don't know if the future's written yet. I don't know if the decision's being made yet. I think there's still. I don't know. I think we're still in a discovery process. It's hard to say whether we know exactly where we are in this market. I think it's still very much touch and go.
Yep, I would agree with that. I do think there are a few things to shake out. Yeah, exactly, Terry. This is one time when taking it one wave at a time is likely most appropriate.
Exactly. Yep.
All right.
Your lead, Bennett.
All right, that's it. Anything specific you guys want me to look at in the indexes?
I'm pretty sure
take us away, man. Your show.
All right, sounds good. Let's hit it. Hard right edge of the MotiveWave platform. We'll catch you guys in just a couple of minutes. All right. Good morning once again. Hopefully we can get through this. It looks like the connection is solid, so I'm assuming they have resolved the issues. It's a welcoming sign this morning. Let's hit it. Hard right edge of the MotiveWave platform. We're going to take a look first at price action in the S&P 500. We're going to discuss first the idea that the 2022 decline is simply a correction and it is either at or near completion. Now, 2 weeks ago when we met, and we apologize for not having a Wednesday live stream last Wednesday, we had a webinar that last Wednesday night. Hopefully you guys were able to join us for that. But looking here at the S&P 500, and as we discussed on the 12th, we see two overall possibilities in regards to the idea that this is a correction. Possibility number one would be to suggest that October 13th actually marked the end of the corrective pullback here in the higher degree wave 2 position. And the reason why we continue to view that as a possibility was, number one, due to the fact that we do have a completed 5-wave structure. So from an Elliott Wave perspective, viewing this as a completed corrective trend is appropriate. In fact, if you'll recall, our downside objective in this C wave was the 1272 external retracement of the summer rally. That level came in at 3469.48 in the S&P 500, and the actual low from October 13th was 3469.58. So we came very close to that downside objective, and as you can see here, we have since moved above what was support that turned resistance on October 5th. That level specifically was near the 3800 handle in the index. You'll notice back here on May 20th, that is where wave B of this wave 4 found support, which, by the way, was right at its 1272 external retracement of its A wave. From there, you'll notice as we break south of it here in September, we kind of back tested into the October 5th high, and then we break down to 3491. So we have pushed successfully above that, and we discussed the idea of a 3800 retest in a wave 4 flat. Now, regarding this wave 4 flat, if we were to view this independent of the overall 5-wave decline, so said otherwise, if we were going to analyze this flat from the September 30th low into wherever it completes, it could still be viewed as an appropriate overall Elliott Wave correction. The B wave, yeah, it overshot its 1272 compared to the A wave, but we obviously had a catalyst associated with that gap down on the 13th. The 1272 was 35 1/4, 3491 is an appropriate low. From there, which you'll notice this is what happened back in May 20th, from there in June, we essentially met resistance at the 1272 of the B wave. So if we consider that same level, our C versus B 1272 objective, that doesn't come in until 3897.5. The issue now becomes the magnitude of this overall fourth wave and the duration of this fourth wave compared to the wave 2 of the same degree that we're pairing it up against. And based on yesterday's price action, I feel this fourth wave is a little bit long to be paired up to the wave 2, which means while it's valid to be a flat in and of itself, I think it's more likely that wave 4 was October 5th, wave 5 was October 13th, and that means that the overall 2022 decline may be complete. And that's something we talked about on Twitter back on the 13th and with you all last 2 weeks back. So if this is in fact a completed correction, it respected the fib relationship to the summer rally in that it found support more or less near the 1272. But what's even more interesting and more fascinating about that C wave low is this. If we consider time elapsed from June through August, so essentially the duration of the summer rally, if we consider that duration and then project that from the B wave, we're going to notice that the August through October decline was exactly equal to the duration of the June through August rally. So that suggests to me that these two legs are associated with one another, and this could be wave C of 2, and the lows are in. Now, if the lows are in, we have a little bit of an unusual pattern coming off of the low. Zooming in down on the 1 hour time frame, this could technically be some sort of a move up in wave 1, wrong keystroke here, up in wave 1, sideways in wave 2, with this being a wave 3 breakout. If this is a wave 3 breakout, I feel that from the October 21st low into yesterday's high, we have another wave 1. This would be wave 1 of this orange wave 3, which means it's going to come down to what occurs over the next 3 to 5 maybe even 8 trading sessions with the Fed decision next week. So that's possibility number 1. Possibility number 2 is that this is simply a 2008 repeat. And we looked at the correlation today compared to the 2008 pattern, and it is quite remarkable, but I don't necessarily feel that, fundamentally speaking, we have the catalyst yet to substantiate such a significant haircut in the indexes. But this is a possibility. This is the alternate possibility that I am watching and will respect in the event the markets turn sharply south. This would suggest that we still have that same 5-3-5 progression, but instead of that being all of an ABC, this would now be either AB12 or 1212. It really doesn't matter. Long story short, if the move off of the low completes as 3 waves and turns south, I would then be viewing that as a move lower in a wave 3 decline. Now, that means that, see where you see this orange A and orange B? Back over here, this is orange 1 and orange 2. So this 5-wave move up that I just talked to you about from the October 21st low, in the case of the 2008 repeat count, that's a wave C position. So that's why I feel it's going to come down to how the market responds to the 5-wave rally from the October 21st low into yesterday's high. I have that decomposed over here for you on a 10-minute chart. Here we can see the October 21st low. This is either B in the bear count, and this is either C in the bear count, or in the bullish upside resumption count. This is simply a 5-wave move and should now give us some sort of a 3-wave pullback for upside continuation. In fact, this orange 5 could extend a little bit further based on the fact that this wave 5 is extending. So this is up in 1, back in 2, up in 3, down in 4. We pair up. Here's your extension. Here's your clearly discernible 5-wave move. You can't really count 1 in the 1 and 3 position. Yeah, you could in the 3, but it's not as clear as it is here in the wave 5. So wave 5 is extended. This is 5 waves up to either be a smaller 1, or, as I just mentioned, that's wave C of wave 2 in the 2008 repeat. So personally, I feel dismissing the idea that this is a wave 4 flat actually works in our favor. As with clients at Trading Analysis, we will not have to juggle whether or not this is going to be a wave 5 of CLO if we turn south, or if this is a 2008 repeat. So that's the S&P 500. Looking at this in the NASDAQ 100 really quickly to wrap up, we've got the same possibilities at work here. You'll notice we respected the 1272 of the summer rally, and guess what? It was exactly equal to time elapsed in the summer rally. So the lows could be in. It all comes down to the next 3 to 5 sessions. Eager to see how things pan out. That's it from me this morning. Let's jump back over to the Trading Analysis team. Andrew says a flat and a diagonal. Thought it was usually frowned upon. Yeah, Andrew, I'm glad you brought that up. I'll send you the link, but if you could drop me an email, bennett@tradinganalysis.com, I'll send you the link to the live stream where we talked about that leading contracting diagonal in the index, because you're spot on. Number 1, the leading contracting diagonal technically has a wave 3 that just slightly exceeds equality to wave 1, and that flat in the wave 4 position shouldn't be there. It should be a zigzag. However, when looking at the major market indexes, Andrew, we've got 3 of 4 right now that are valid as motive sequences. Therefore, I think this is an instance where we have to allow for the exception in the S&P and still view it to be valid.
And that's one of the things it's very unwritten. That's what makes Elliott Wave so hard. I know, Bennett, like, how many of you guys, like right now in the stream, do you come, and I'm just curious if you guys would provide a little feedback. Do you come for, the Elliott Wave? Is that primarily what you're here for? Or maybe just let us know, like, what you guys, the other parts. Is it the crypto? Is it your market? Is it rotation? Is Elliott? Let us know, what you're here for. That'd be great. And what you'd like to see more of. And the second part of that is, in all the books that have been written and all the studying that's done interpreting R.N. Elliott's work back to the 1930s and 40s, like, there's one thing that I don't think people are talking about that Bennett just mentioned, that usually there's one part of a 5-wave move, or a particular part of a 3-wave correction that doesn't fit the ideal guidelines or rules. There's usually one part of a complete pattern that just doesn't quite work. And to what Bennett just said, you don't want to throw the baby out with the bathwater, right? You don't want to throw away a pattern that 1 or 2 degrees larger really fits and makes sense for what you're observing in the market, but just one little part causes you to doubt it. I think that's something that we need to address, and there's a lot of confusion in the Elliott Wave world over the last 100 years. I don't think addresses that properly. So, discussion for another time. Let me know what you guys think. TA team, anywhere you want to go with that one, or we can leave that one right there.
No, I think it's a good discussion. That's something you have always taught at Trading Analysis, and I think is a little bit harder for newer Elliottians to grasp, or maybe perhaps learn how to apply. Identifying where that structure might come in.
Right.
But I think this is an instance where, to your point, we need to allow for this to be a valid interpretation. And even Robert Prechter, in the most recent edition of the Elliott Wave Principle, acknowledged on page 41 that perhaps those rules were too objective and therefore needed to be reclassified and investigated further. And that was pertaining specifically to the contracting and expanding diagonals.
Right. Long discussion, and
Yep.
I really enjoyed doing the webinar with you the other night.
Thanks, man.
Just really talking about Elliott Wave at the highest level, and what it serves for us. And I think the biggest distinguishing thing you'll see about trading analysis, and there's a lot of companies out there that use Elliott Wave for their primary way of trading and investing and analyzing. And I think the biggest takeaway of trading analysis is we're traders before we're analysts. And Elliott, used the way that we use it, lays out multiple scenarios or multiple possible outcomes, and we use it as a trading methodology, weighing the validation and invalidation points that become your entries, your take profits, your targets. It's weighing the multiple possible outcomes, probabilities of outcomes, and that helps you guide how to put your capital to work in a responsible way. It's not a long-term forecasting methodology and say, here's where we're going to be in 2 years. Good luck with that. You might as well flip a coin, I think, but analyzing where we're going for the next couple swings relative to your trading time frame, which is defined by how much risk you want to take, it's wonderful. So it's a trading methodology to us, not an analysis, long-term analytical approach. So again, take that for what you will. Discussion for much longer time, but I'm curious what you guys who come here every Wednesday, the way what you get from it, what you're looking for us. Any feedback would be very welcome. So appreciate that.
Absolutely. We'll be sure to run a poll as well to gauge their
Yep.
opinion over the next few shows. Very good. Good stuff. All right, Mr. Terry Long, sir, you ready to jump into Optima? Take us through some rotations.
You bet.
All right, take it away. We'll catch you on the other side.
All right. Hello, traders and investors. I'm Terry Long at tradinganalysis.com with your weekly sector focus. So earnings season's just getting underway, and the initial round of bank earnings seems to be coming in better than expected, though, as always, some reports beat and others miss. Tech earnings started yesterday after the bell, and while it's still too early to tell, those first tech reports were mixed, with Google missing, Microsoft beating, though both have moved lower in after-hours trading. So don't be surprised when you see the markets open lower this morning. In either case, expect higher volatility to return to the markets during periods of uncertainty. Now, last week's price action saw the market here open Monday with a gap back above Friday's close, and Tuesday, another gap higher. Middle of the week trading last week was mostly lethargic and consolidating, but then Friday brought on another strong move. Now, for the week, the S&P rose 4.74%, and it erased all of the prior week's losses. The NDX moved in a similar fashion, gaining 5.78% last week. Now, 10 of the 11 sectors last week finished in positive territory. It was the utilities sector seeing a net decline of 0.31, the only one under lagging conditions there. Energy sector rebounded sharply, rising 8.28%, and it finally invalidated that triangle count that we've been sharing with you, with a solid close above those August 29th highs. Now, Perhaps a bit surprising was technology sector's outperformance of 6.46% last week, and the consumer discretionary sector was the third best performing sector, rising 5.27%. Now, let's fast forward to what's happening this week. My little column chart over here is actually at yesterday's market close, but my table is more current with the pre-market, after hours, and the pre-market moves happening. And you can see they don't line up. But after market close yesterday with the tech earnings reports, there was a dramatic shift that throughout all of the sectors, because we actually had the real estate sector, the communications, and the technology sectors in a totally outperforming mode. But then after the earnings reports came in, we now see that communications and technology are down towards the lower end here, underperforming the S&P, which has netted a 2.8% move in the last couple of days. Real estate sector actually getting some rebound from a heavy drawdown, like a 27% move off its August highs. Energy sector getting a little bit of a bounce there, and so is utilities. Utility sector has been pummeled recently with a very sharp drawdown. So these are some reactionary moves, I believe, off of the lows, looking for some stability there. All right, let's fast forward over here to the relative strength sector leader scoreboard. Now here you can see the energy sector continues to make rapid gains in both momentum and relative strength, and is positioned way out front in the leading quadrant. Now, this week, we've also seen the healthcare sector moving back up into the leading quadrant, actually overtaking both the utilities and the consumer discretionary sectors for second place in our leaderboard. Now, the consumer discretionary sector is still winding down with momentum, but it just doesn't seem to be shedding much relative strength, and it still holds the number 4 position here. Industrial sector had been slowly inching to the northeast, and it took a rapid reversal last week, but it does look to be still holding that position. Now, the staples sector has been seeing rising momentum, but it just can't grab hold of that relative strength move, okay? It is there for a while. We saw the healthcare, if you look right here, you saw healthcare and staples, both of them reversed back to the north and had started growing. But really the healthcare sector, I think, is the one that's demonstrating a lot more strength. You're finding stronger stocks inside this group. Staples is seeing some momentum return back to neutrality, right? So if you're here at the 100 line, you're essentially neutral relative to the S&P. Now, the financial sector has moved back over into the leading quadrant. The momentum fell off just a little bit, but like I said, those bank earnings actually were pretty strong, and the bank stress tests and all that other, I think the banks are in much better condition coming in today than they were, say, back in 2008, 2009 decline. That was the whole thing, was a credit crisis, and the banks just weren't up to par. Now, the underperforming sectors include the technology sector and the real estate sector down here in the lagging quadrant. The materials sector and the communication are also considered underperforming because they are below the 100 line here on terms of the relative strength axis. But you can see, this is what Todd was alluding to earlier, that we were gaining up until the earnings report on Google last night. We actually had been seeing some momentum and relative strength gains show up here in the communication sector, and the materials sector also with the northeasterly heading. And that northeasterly heading means we're gaining relative strength and momentum simultaneously in these markets. So I think it's too soon to tell if the tech earnings alone will be the catalyst to turn the tech sector back around. For now, keep focus on those sectors and stocks within those sectors that are pushing up and to the right for the market leadership position. Send it back to you, Bennett.
Very good. Much appreciated, Terry. Eager to see where the week takes us, and of course where next week's Fed decision takes us. Excellent coverage as always.
All right, sending the screen to Alex, so he'll be ready.
All right, Alex, you ready to rock? Got your screen shared up?
Yeah, let's go.
All right, sounds good. He's going to take you through the macro scene. We'll catch you on the other side.
Hey guys, let's go as usual over a couple of macro themes here. So let's review first what market is having for us for the next week Fed meetings. It's not just a Fed meeting. We have actually tomorrow the ECB. We have a Bank of Canada, I think, in a couple of hours, and we also have Bank of Japan. So next week we will have a Fed and Bank of England. All of these are very important meetings in these times. So ECB is poised to go for 75 basis points on the upside. And also, as you can see, market is already almost at 96% for the 75 basis move, which will place us up to 3.75 to 4% range. So what is interesting when we look 14th of December, these probabilities for the 75 basis points move are diminishing. So we are more looking, I think, for a certain decrease in the rate, how the Fed is actually observing the situation. So if we go to the 1st of February, which is a pretty far off, where the things are happening so fast, we are also see decreasing. So I see rates kind of stabilizing between 4.5 to 5%. And also one of our charts where we actually track the 10-year yields are suggesting we are coming to a pause. This is the wave count I'm tracking here. So we came very close to this 1618 projection for the yellow wave 3, which is the intermediary 5-wave move on the upside. So I do expect rates after the 2nd of November to start moving in some type of a sideways consolidation before we have the last move on the upside and a bigger pause, which I think it's going to come around, let's say March or February, March of 2023, and it's going to last for some time. So this is what I'm seeing on the 10-year yields in the US. On the 10-year Bund, which is the German equivalent in the Europe, our chart is also working pretty nicely. So market already, I think, is pricing in a 2%. So I think we are going to see also the pause, some type of a sideways movement, and then we're going to finish around 3% around March, which is actually what is the Euribor 1 through 6 months futures are also telling us. So the futures market are also kind of predicting 3% for the ECB. The propensity for ECB to move rates higher, I think it's very limited because of the dire situation the European are in because of the Russia-Ukraine conflict. So I think we're going to also stop here. We're going to have a pause, which kind of relates, and now these two charts kind of tie them together for the outlook of rates. So my view on the rates will be that we're going to see a significant pause coming from February, March 2023. And I think it's going to be a rather significant pullback in rates, which will allow markets to go much more on the upside that we are seeing currently. So if we go to the dollar index, Bennett and I are closely monitoring the dollar index. This smells like an ending diagonal, which is still not completed. So I don't think dollar has finished this cycle move on the upside. I do expect a little bit back and forth moves on the upside, maybe a little bit new highs between 114, 115, 116 before we see a larger pullback. And this ending diagonal kind of also reflects this interest rate differential, which is also brewing up here. We have seen the last week, and it's an interesting thing that the Bank of Japan actually made intervention, silent intervention over the weekend where the market was not actually open. They spent around, I don't know, 30 billion for this intervention, and the market is moving back up on the dollar yen. So this carry trade is still very alive, but I think when the rates are starting to move in this consolidation, that dollar yen will have some type of a corrective pullback. On the commodities front, Thomson Reuters index are still moving according to our chart. So 5-way move on the upside in a wave A has finished a little bit above one of our ratios, and I think we are in a B-wave consolidation until the dollar actually completes its ascending diagonal. So also the oil chart suggests a little bit more downside. I do see this still as a 3-way move, possibly a little bit more upside in the X wave and the move lower. If we look some other commodities, soybean is also in some type of a move, corrective move upside in a B wave, so I expect more downside when this is done. So all of this corresponds with the cycle of dollar as well. And kind of when you compress these things together, all of this suggests that we will see either a bigger or a smaller rally in commodities when dollar actually completes its cycle, which we discussed just seconds before. As the net gas is concerned, this is the Henry Hub futures. I still do see this as a 4th wave consolidation with one more move on the upside. So if we switch to gold and silver, we didn't see anything drastic. Silver is still, I think, in a consolidation, goes very well with the chart of dollar index, possible ending diagonal here with a little bit more downside, and gold is in the similar situation. So I think we should, as always, pay attention to this developments in the dollar index and actually time the possible lows in gold and silver for the further move on the upside. So the cryptos, Bitcoin, tomorrow is the crypto lab. I will go further. So we have seen a small move on the upside. We have warned our members here for a possible move. I do see this still as a triangulation. If you look the higher time frames, this is still within the range. Very kind of a tough consolidation from the part of a Bitcoin. So I still do see this as a possible consolidation before the last drop on the downside in the 5th wave. But more on that tomorrow on Crypto Lab. So back to you, Bennett.
Very good. Much appreciated, Alex. Getting a little bit of feedback there, but not
a little
bad.
Feedback there, huh?
Yeah, not too bad. Not too bad. Got about 4 minutes left here until the open. Todd, I'm going to pass the screen your direction.
Sure. Let's see. Number 3. Share. There we go. Yeah, good work. Yeah, nice move in cryptos, Alex. I'm looking forward to that the crypto lab tomorrow. You know, from a macro point of view, dollar off, rates kind of moving. And was there anything else specific with crypto with that nice move up and Ethereum and Bitcoin?
Yeah, I think it's related with stocks. Basically, I had these two charts together as the stocks was moving up, cryptos was moving up. So basically the same one-on-one correlation.
Yeah. Yeah, I'm interested to see, and especially as Ethereum continues to have a relative strength to Bitcoin. So I'm curious what you pull away on that one.
Also,
yeah. Go ahead.
Ethereum Bitcoin chart is regularly on Crypto Lab. So if you're interested, guys, to see it tomorrow, I go in a depth of it. So it's Ethereum is very bullish on that chart over the Bitcoin in the next cycle on the upside.
Right. All right, perfect. So just a couple random thoughts here. Just the way I see the market, bigger picture, kind of pulling everything together that Terry, Alex, and Bennett put out there. You know, from Bennett's point of view, is the Elliott Wave count showing that we have something more significant on the downside, or is it corrective? I wanted to start actually with this chart. Hopefully it's not going to break MotiveWave. Let me see here. Okay. So I put this out on Twitter yesterday, and Bennett's been tracking the wave count of 2008 to today. And this is kind of fun, overlaying, the NASDAQ or the S&P back on prior significant sell-offs. This is with GFC, global financial crisis. in yellow compared to the NASDAQ today. And it's always kind of fun to try to figure out the relationships and if the analog is in fact valid. And there's two ways that I look at this chart from 2008 to today. If you look at the NASDAQ right here to here, so June into the October low, we've made a new low. If you overlay that compared to the NASDAQ back in 2008, and as I put my cursor up here, you might be able to see the dates. It's hard to see there. So that's July 2008, late 2008 right there. You'll notice in yellow that the NASDAQ actually made a higher low where the analog overlay made a lower low. So one of two things, and this isn't going to be a great takeaway, I think, is either the market is weaker today than it was back in the GFC sell-off, and we are going to fail and head lower. And if you look at the percent decline, if you are approximately here back in 2008 or here, the market was using this scale 0 to down 10%, this gives you down 40%. So you might, if this is going to be the comparison, you might have another 30% on the downside. The other way you can look at this is, okay, maybe this is just the double bottom that we saw in 2008 and 9, but it happened 3 to 4 months earlier, right? This is actually about 3 to 4 months in time. If you're using history as a guide, is this a double bottom, or the S&P made more of a double bottom? And if you look at sectors, as Terry was mentioning, that perhaps didn't break the June lows, and there are plenty of them, consumer discretionary, financials, energy. This is technology, so it's going to be XLK, but there are some sectors in there that didn't make a new low. Okay, so maybe this is the double bottom, 2015 and 16, but heading into interest rate hikes here, Chinese tariffs from Trump here, the market was hanging in there pretty well. And the Fed was actually withdrawing some liquidity here before we went into COVID, and this was a tech-led rally. So we've seen a larger balance sheet runoff in this period right here than actually we've seen right here. Seems to be the market is reacting much more sharply. And of course, that's more to do with interest rates rather than the Fed's balance sheet level. But there is precedence of the Fed withdrawing liquidity and the market being able to rally. Of course, we rallied right into the global pandemic and we got smacked. So I don't know. I think it's telling how little the Fed has reduced the balance sheet combined with how far the stock market has sold off. More kind of random stuff. The housing data was interesting. And again, I think that's something that we need to take with a grain of salt. It's related to interest rates. So it's all kind of tied in this macro discussion. So this is the Case-Shiller index that came out yesterday, S&P Case-Shiller home pricing index. It's the largest decline on record. So this is actually for August. So it was reported in October. Actual was 13.1. And then if you look at the last August reading, it was 19.7. It was revised to 19.6. You had a 6% year-over-year drop in housing prices. And you got to say, well, that's concerning. Oh, my goodness. Interest rates, higher interest rates. But again, context is so important here. I mean, what is that, a 38% drop from what we've seen in the housing price run? It's a big drop. The context around it is how far housing prices have come. This is not something that I think is overly scary. And I think it will lead into more relaxed CPI readings and the Fed's reactions. And, something that I've mentioned before and I find interesting is if you look at home builders, okay, we just had some pretty negative on the headline home building numbers, but remember what I said relative to the June lows. Here's the RXHB, so the home building index overlaid with the 10-year yield. And of course, the 10-year yield I have flipped upside down. So it's basically the 10-year bond, just to make it easier for comparison. So this is the 10-year yield starting to push lower. And if I flip it upside down, you will see XHB, your home building ETF, made a low here in June and is significantly higher from that June low is yields have made a new high, right? And we actually went right into the 786 retracement right there. And we're starting to actually act pretty strong. And the fact that yields now, again, the yield chart going up means actually we're pushing lower. So we're starting to see some relief in yields, and home builders, if we're really going into a housing depression, I wouldn't expect to see the home building ETF make a higher low relative to the June lows. So you guys just got to wonder, perhaps that unbelievable move up in real estate prices coming down are going to make houses more affordable. We know commodities have come off. So is housing going to be one of a major source of an economic downturn? I don't think so. I really don't think so. And we're starting to move up off. 2-year did make a new low, starting to move up. S&P starting to move up. And the dollar is actually leading the way on the sell-off. Remember, this is basically the euro or the sterling, right, against the dollar, because this is dollar flipped upside down. If that dollar were to move above this line, which again would be a new low, which would be around, what is that, 10, whatever the level is in the dollar index, I forgot where it is, which scale it is, 110 maybe, you guys can tell me. But if the dollar were to break this resistance, which is actually support on a regular chart, you got to think that that's going to impact treasuries, and treasuries will begin to move up, yields down. And I think that would, again, be a macro influence to helping the stock market find a low and figure out which wave count, in fact, we're using. And again, housing prices, and also we didn't get to talk about it, but consumer discretionary is one of those sectors. And I'll just overlay it here, instrument overlay. Consumer discretionary in an inflation squeezed economy with higher rates, higher borrowing costs, you'd expect to see consumer discretionary much worse off than it is. And right now it's not. So let me just thicken this up. I'll throw XLY on there. So if we kind of scroll this back to the June lows, consumer discretionary made actually a slight higher low, where the S&P and the NASDAQ made lower lows. That all leads into bonds going up, the dollar going down, and I think stocks continuing to push higher. We'll see what happens with earnings season, but the macro forces are doing their part to try to help bottom this market. We just got to see what earnings season has in store. So very touch and go in here, guys. Back over to you.
Very good. Much appreciated, Todd. Excellent coverage as always. We had a little packet loss here and there throughout that, but it came across well. I was watching. Yeah, I was watching on the LTE. We should be good. And if you guys did miss it, members, we'll cover the markets here with you in about 22 minutes. We've got 8 minutes here until the open. Take a look at Microsoft, Google. We'll see how their overnight developments are absorbed into the cash session, and of course, be back with you guys same time, same place next week. If you're interested in Crypto Lab with Alex, same channel, 9 a.m. Eastern tomorrow morning. Gentlemen, appreciate it. Yep.
Before we sign off, we've got a shout out Enduro Mom, and that super nice comment she put at the top. Will you throw that out there?
Absolutely. Yeah, I can't throw it up right now because I modified things on my end for bandwidth purposes during your presentation, so I lost the chat, but
oh, got it. Super nice comment. We appreciate that. She just joined our community. She said, my second week being a member, there's always more education and analysis than advertised. Very satisfied and sleep better knowing every trading day I have a plan to trade. Wow. Boy, we should have paid for that endorsement. Appreciate that. I'm glad you guys joined us.
Absolutely. Glad to have you on board. Members, we'll see you in 21 minutes. Yeah, go ahead.
I'm reading. I asked the question on chat. I am going to read it. I'll just... guys, I'm going to respond here for a sec on text as we shut the stream down, but I appreciate the feedback there, guys, as we asked for. So thank you.
Yeah, most certainly. We'll have to put out a poll as well over the next couple of live streams. If you guys enjoyed the content, please give it a thumbs up. Subscribe with notifications. It lets the YouTube algorithm know to distribute it accordingly. Great way to support the Trading Analysis team. Check us out, anytimetradinganalysis.com. We'll see you guys same time, same place next week. Have a good one.
See you later.
Take care.
See you guys.